Bill Baruch, president at Blue Line Futures. Bill, always good to have you with us. And it feels like an important week for investors who are trying to kind of read the tea leaves on our market's overvalued, what part of the market is overvalued. Do you think this earnings season, which will start with the big banks, so maybe we start there, you and I, will justify levels or cause concern on the outlook?
I'm really excited for the start of the earnings season. I'm actually overweight banks right now, and I've been using weakness to add more. Something I was talking about last week, and one of my writings was looking at regional banks. But I own a number of them, and I think the earnings are going to be surprisingly well compared to where the market is right now. And I think that's going to find investors and portfolio managers are going to allocate at these levels. I also am looking at interest rates and looking at the 10-year yield. I mean, we went down to 1.25 last week. That's what's weighed on the banks and weighed on that narrative. I think we have a short-term, near-term floor, maybe intermediate-term floor here in yields for the next few months at a minimum. And that's going to be supportive to the banks. I think, too, there's on a technical basis, if you're looking at the 10-year Treasury, the prices, there's definitely some good resistance up here, technically from a trend line as well as a retracement level. So on the futures side, I'm actually going short the 10-year futures, and on the advisor side, I'm overweight the banks.
That feels a little bit like, heads you win, tails you win when it comes to the banks. Rising rates was good for them. Now we've got rates kind of bottoming out here, but staying down there for some time, still good for them. Is part of that because they're freed up and we should expect to hear maybe in these quarterly reports what they'll do with their excess cash?
Well, exactly. The excess cash, I mean, is definitely going to be something that they put aside last year. They're going to be able to put to work this year. I think that's important. But banking activity, I mean, look at the demand for credit right now is picking up over and over. I mean, you look back at 2019 levels, some of the months earlier this year, I think it was April this year, credit request was about 10% more than it was 2019. So you're seeing big levels being demanded for credit. Banking activity, I think that's going to be picking up in the second half of this year. Sort of, almost a stalled reopening in some ways that people can look at. We had a big flush, but obviously, you're hearing the Delta variant news that's out there. I don't think the economic activities slowed down, but I think we're from a mindset of as an investor, it's definitely slowed some money flow, and I think that money flow is going to pick up in the second half of this year too.
Which I guess, I mean, we definitely are seeing a lot of pausing on some of the very biggest names, the growth stocks that led us here. Where are you on the longer term prospects for the Amazons, the Apples, those big names that really have been able to deliver through this pandemic? Do they keep doing that in the quarters that follow?
Listen, I love those stocks. They're a cornerstone of my portfolio. Apple, Microsoft, and Alphabet are some of my three largest positions. I own Amazon on and off. We're getting the confirmation this thing's breaking out. I really want to see some follow through here. Facebook's another stock that I've owned on and off. I mean, these big names, I think they're going to be leaders throughout the second half of this year. I think you do have to be more selective in the tech that you're going to own. And I think as interest rates pick up, you're going to start to see that. So on the futures side, I'm long the Dow futures, and I'm strategically trading short, whether it's NASDAQ or Russell 2000 against that. And then on the advisor side, I like owning these big tech names, but being very selective on some of the other tech. I'm overweight more of that reopening trade, the value trade, if you will, and a number of travel names, banks, energy. I think those are going to outperform the second half of this year.
So when we're asking this question, are the fundamentals justifying the valuation? We do have to come back to the fact that the valuation is extremely rich. What are the parts of the market you think are most vulnerable to that, to even kind of short-term pullbacks? We haven't seen, right, those even kind of quasi-healthy 5-10% pullbacks in months.
Yeah, and that's one of the things that you got to be really cautious about, and one of the reasons why I try to stay nimble within what I'm managing. And I looked at on the advisor side, I do buy protection, and going into those Fed minutes, I use different put protection on in the SPX to hedge, as well as the S&P futures to hedge portfolios in case of that drawdown did come. And I think there's that's just part of our strategy to be able to take advantage of that, but as well protect the portfolio. And then Friday we roared right back. I mean, the Dow was up nearly 500 points, and Nasdaq was moving well too. So it shows you that this thing is still going. July is typically a very seasonally healthy month, but I'm looking at CPI on tomorrow, and again, is that the CPI going to really get the interest rate story going, and is going to weigh on the tech? So I think again, you got to stay nimble. I do think that the big tech's going to outperform. I want to be very selective in some of the other tech. There are more momentum tech. I think semiconductors are going to be outperform to better. I think there's some really great names within there that have done really well. So I think it's really kind of digesting what's going on a weekly basis. And as the data comes out, the news flow, the Delta variant is obviously weighing on things. But I think we come out of this week and the 10-year yield is going to be higher, and that's something that's going to hold back tech.